June's inflation report showed that prices were indeed rising faster last month. I turned to the analysis of Bankrate senior economic analyst Mark Hamrick. Were you surprised by this report?
Good to be with you, Jaden. I think we go into all these, key economic reports with an open mind because we can know what the parameters are, sort of the range of expectations, but we should always be prepared for something within the report that, is the reason why we want to look at the report in the first place. And the main takeaways here are essentially, I think, two or three fold. Probably, I mean, obviously, we could go into an infinite number of takeaways. But the year over year change in the CPI, 2.7%. The core rate, which excludes food and energy, up 2.9%. People have been and will continue to look for signs whether tariffs are, let's call it, infecting this data. And I think, broadly speaking, not so much, but where you do see some impacts are within specific categories. We can talk more about that later. And then, of course, as we speak, we are a couple of weeks away from the next Federal Reserve meeting, and the question is, what is the Federal Reserve going to do at that meeting with respect to its benchmark interest rate, and how is it viewing recent inflation data as well as trying to be anticipatory with respect to the outlook?
And I know that rate cut we're expecting maybe in the fall, but I know the other variable here, of course, is tariffs, as you mentioned. And there is kind of this delay because we saw in quarter one a lot of imports that had happened because retailers were trying to get ahead of these tariffs. When do you think we will see the impact of tariffs in terms of prices?
Well, I think we're seeing some impacts already. And, when we look at prices, let's say grocery store or wherever they may be, in a furniture store, in a hardware store, thinking about the wide range of items that we import in the United States in this globalized economy in which we reside. We know that we don't grow coffee in the United States. Coffee prices stage a significant increase here on a month over month and year over year basis. We're seeing cost increases in things like furniture. And I think we'll see more of that in consumer electronics. And it really remains to be seen. It's sort of like there was an idea back in the day when I was a kid about seeing along and following the bouncing ball. We're following the bouncing ball on whatever tariffs are on a nearly daily basis. And I don't want to say where they level out. They may never level out. They may always be bouncing around. But I think one of the things to think about or to anticipate is that this is a tool in the president's box, which he shows no inclination of moving away from. So whether it's a 30% tariff, a 200% tariff, a 1% tariff, it's sort of a benchmark, or I should say baseline 10% tariff approach that the administration seems to be taking. Let's define what tariffs are for purposes of those who are watching. And I think most of us are pretty darn aware of what these are by this point, but sometimes we need a reminder. Tariffs are a tax on imports, and they have to be absorbed or paid by some combination of the business importing the item and the consumer that ends up buying it. And there can be secondary businesses that buy it as well. If we think about something like automobile parts, an automobile is a collection of items that are made by any number of different entities. Um, those impacts are likely to continue, and they may present themselves, let's say, in a more robust fashion in the coming months. And you're very wise, Jaden, to zero in on the pull forward reports that we saw, for example, in the first quarter, where businesses are trying to get the timing right. And so when you get yet another pause in imports, and as we speak, retailers are very mindful of the approaching holiday shopping season, even though it's not top of mind for consumers, because think of the time that's required to do manufacturing. Toys, obviously, are a thing, as are consumer electronics in the holidays. And those are some items that are very much targeted by tariffs. Think about, so many toys, for example, come from China. And, for those that celebrate Christmas or the holidays, are they going to not allow their children to have some aspect of what they want or feel like they need for Christmas? Probably not. So parents are going to purchase some of these things and going to essentially have to swallow all of that. So we don't, the quick answer to your question, since I didn't give you a quick answer, is the quick answer is we don't know when the broader part of these impacts will show up, but it is that sort of paralysis that is leading the Federal Reserve to just sort of try to freeze itself to say, you know what, we know that our benchmark interest rate, we believe that our benchmark interest rate currently is restrictive. Think of that like putting the foot on the brake in an automobile, as opposed to putting the foot on the accelerator and lowering interest rates where rates are no longer restrictive. And the Fed doesn't feel like it can move away from a restrictive posture, fearing that these tariffs are going to show up in the form of price increases. And what is the Federal Reserve's main mission as prescribed in law? It's two things, the so-called dual mandate. Sounds fancy, but really it's the hashtag you had one job. Well, the Federal Reserve has essentially two jobs, and it is number one, to strive for price stability. That means to keep inflation under control. And job two, and this is in no particular order because they both are key, is to have maximum employment, the strongest possible job market. And if either of those aspects of the dual mandate are at risk of, let's say, deteriorating as opposed to remaining stable or improving, then that's where the Fed starts to think about adjusting its benchmark interest rate. Lower rates to help the job market, higher rates to try to combat inflation.
And we see the president who is pushing the Federal Reserve to lower interest rates, but at the same time, his tariff policy is running counter to that because the Fed is exactly holding interest rates for the purpose of seeing what the impact of these tariffs are. So it's doing the complete opposite of what the president is wanting and his goals. But I do wonder, though, we've seen such a range of tariffs come down from the administration. You mentioned the 10%, we got even as high as 145% with China. After
Right.
what point does it make a difference what the tariff is? Because I kind of lump 10 and 30% tariffs together, but is there a certain point where these retailers can no longer absorb the tariff?
Uh, well said, and a good question. So essentially, when we had the 145% target for China, I think that is seen as essentially saying, well, there that is not something that is either sustainable or is workable from the standpoint of, an entity going to essentially swallow that cost at a higher price of, plus 145%. So essentially, that means that you have, and I think the Commerce Secretary has said this, or maybe it was the Treasury Secretary has said this, that essentially that ends up being a trade embargo, meaning no trade. And at a lower level, sure, there are, let's say, goods that consumers are willing to pay, another whatever the factor is, because they need to have it, they feel like they want to have it. We think about something like salsa, right? You can make the chips in the United States, but we don't have year-round access, generally speaking, and at least in terms of meeting demand with avocados or tomatoes, right? And so, are you willing to pay another 10 to 30% for avocados and tomatoes? Businesses are thinking, well, they have to supply the grocery store, right? And then consumers, if they go out to their favorite Tex-Mex restaurant, they're not going to be happy to see an increase in the price, but they're going to want their chips and dip as well. So I would say ultimately let's maybe try to slice and dice the question another way. When we talk about consumer spending and at Bankrate, we're very focused on trying to encourage people to prioritize emergency savings, where most Americans live paycheck to paycheck. In an environment where consumer prices are now 24% above where they were in January 2020, as measured by the Consumer Price Index, broadly speaking, people start to make decisions about what do I have to buy, what do I need to buy. If you crash your car, or somebody crashes into you, you may have to replace that car and you don't have any other means to get to where you need to go. Maybe you're working, etc. So a vehicle isn't necessarily a discretionary purchase. The vehicle that you purchase is discretionary in the sense of you have choices to make, new versus used, dot, dot, dot. And we have to fuel our homes. We have to, have the heating or the AC on. There are some things that we just have to purchase. Shelter is another one, whether it's through rent or mortgage payments. At the other end of the equation, do you really need to buy that new iPhone? Do you need to upgrade, your 2021 widescreen TV to a 2024, 2025 version? How much travel do you do, right? Whether it's driving in the US or flying across the country or even abroad. So discretionary and essentially necessities really do come into play, and that's where either the businesses or the importers will be deciding, how much of this can we eat? How much of this, meaning how much of the price increase can we eat? Or how much do we allow it to weigh on our profits? And that's the latter is probably to some degree a great risk, even in an environment where the stock market, as we speak, has continued to chalk up record highs. After taking the initial drubbing in early April after the president's initial announcement, and then the taco trade, Trump always chickens out, being the severe take on the adjustments that the president has made in the tariffs rates.
Retailers do have a very thin profit margin. And so this can be especially difficult in terms of making those decisions. But I do want to cover that a little bit too, because the markets today are having a mixed response. We see that the Dow is down about 200 points this morning, but you see the other indices are not too shaken by this. Are the markets really threatened by the president's tariff threats anymore? Because it seems that initially in April, we saw this massive crash in the markets, but now there's just this little reaction that we're seeing to these additional thoughts about tariffs. So are the markets just unfazed by this at this point?
Ultimately, I think the markets don't take the administration seriously in the sense of believing that what is announced today is going to be in place a month or 3 months or 12 months down the road. But to my earlier point, I do think, there's a saying about the president, you should take him seriously, but not literally. And, meaning, some things about the administration are not going to change, but some things about the administration are going to be here to stay. Volatility, disruption, going to that toolkit with the tariffs, blasting people on True Social, lately the Federal Reserve Chair. So I think that markets are essentially, and they could be wrong, right? Stock prices are adjusting all the time, meaning, they're not set in stone. Um, what we might be talking about a year from now could be a completely different set of parameters or considerations. But I think that to answer your question more succinctly, I think that the many investors are viewing what the administration is doing and saying, ultimately, it's possible that cooler heads are going to prevail. And if we thought about different people in the administration who are essentially the more strident tariff advocates versus those who apparently were able to get an audience with the president who said, you know what, you're hurting your own people. You're hurting the financial markets. Do you want to be the president who's associated with essentially hurting your base that voted for you with higher prices or even lower employment? Because, for example, the manufacturing sector is continuing to be in a rut. So while the president may have uh, intentions of trying to build up the U.S. manufacturing sector, it is anything but robust right now. It's been in a contraction mode for the greater part of the last 2 years. So I think that investors are thinking that the cooler heads on the tariffs front will prevail, but it is a bit of a guessing game. It's a bit of a bet to make.
Yeah, and I do just finally here want to touch on the job market because we've been seeing these past few job reports. Healthcare has been dominant, and we've seen that that industry has really been a sticking point. Are there certain industries that are just not going to be responsive to tariffs? Are they kind of concealed from those tariffs? Is that the case with healthcare?
Healthcare definitely. Of course, if we see a hit taken from the cuts in Medicaid,
Sure.
that's going to hurt certain aspects of that industry. But it's a fifth of the U.S. economy, and we're an aging population, myself included. And so, as we have an aging population, we need access to healthcare, pharmaceuticals, which obviously another area the president has targeted with his tariffs. You need various forms of therapy, occupational uh, rehabilitation. So there is going to be a strong underlying demand for healthcare in this country. But we also have to think about the huge divide when it comes to both wealth and income inequality. And so, I try to caution people not to use the sort of phraseology of how is the consumer doing, because in our country we have, hundreds of millions of consumers, and there are those who have essentially very strong access to financial resources, and then those who are in the lower and middle income categories that are struggling. And that we're not even talking right now about access to housing or education or things like that. So I think that it's going to get, obviously, it's going to be something to continue to watch. At a baseline, what we saw in June was a surprise in the sense of the nation's unemployment rate falling to 4.1%. But the number of people being hired is moderating. And we, as you said, we did not have good sector participation in those that were adding workers. So there are aspects of the economy that are performing well. There are some that are struggling. And let's remember, as we talked earlier, we're still in a restrictive interest rate environment. So you think about interest rate sensitive sectors of the economy are still, laboring under that. The housing sector being one of them, where you have the Bankrate weekly average for 30-year fixed rate mortgages still pretty close to 7%. And so it's not only for those that are aspiring to buy a home, it's not only the cost of that house, but it's also the ability to finance it at a rate that can keep your monthly payment at a manageable level.
Yeah, that's certainly something I was watching in just today's report when it came to the CPI was shelter, because that was repeatedly the concern with inflation. But it seems like this time around it wasn't as big a deal in comparison to those other categories.
That's been one to watch, and it will continue to be so. Whether you're a central banker or an aspiring homeowner or one who's fortunate enough to own a house as an asset. I think we probably have more sufficient supply of rental properties available now than we did before. Home prices are cooling and even declining in some parts of the country. But, we're talking about really what has been a years-long housing shortage in the United States in the sense of the housing stock that is available for people to buy. And a relatively high interest rate environment is one that produces the so-called lock-in effect, where people who currently own a home are reticent to move to another house because they don't want to pay that higher mortgage. And that means that that housing stock they're currently occupying is going to be occupied by them for the foreseeable future. And it's hard to find a scenario where you think mortgage rates are going to go much lower from where they are here, but the expectation among those who we've surveyed at Bankrate for our surveys have indicated that people think we'll see some modest decline in the mortgage rate between now and the end of the year. But that is going to be more of, let's say, something on the margin than falling out of bed. And that'll be something to watch as well.
For sure. Well, Mark Hamrick, Senior Economic Analyst for Bankrate, I appreciate you joining me.
Great to be with you. Great questions. I appreciate it very much.